This is the second part of the lecture for Unit 1, focusing on financial reporting basics. Essentially, what I'm going to do here is absolutely blow through the state and local government financial reporting model. Basically, start to finish, cover the structure of the report, the financial statements that governments are required to present, talk about a few of the more prominent note disclosures that go along with that, and a couple of required supplementary information presentations. But I'm going to move quickly because I don't want this lecture to last all day long, and I can, in fact, and have on many occasions, lectured all day long on the financial reporting model for state and local governments. So let's just begin by looking at the comprehensive annual financial report, although emphasizing that most governments don't, in fact, do a CAFR. They are required, and I'll show you in a second, to do basic financial statements, notes, and RSI, but there are about 5,000 or so governments that present this more comprehensive document that includes 3 sections: an introductory section, a financial section, and a statistical section. Within the financial section, there are the basic financial statements, notes, and RSI, and then supplemental statements and schedules that follow the RSI. It's this basic financial statements, including the notes, and the RSI that is the basic required part under the governmental accounting standards. So within that required part, the first thing you see is management's discussion and analysis, which is a form of RSI, the only RSI that appears in front of the statements rather than after the notes to the financial statements. And that MD&A, as it's called, is essentially overviewing and summarizing and analyzing the information that is in the basic financial statements and notes and the RSI. So you're essentially, as you progress through the document, starting at the highest, most summarized level and getting succeedingly more and more detailed and more into the weeds as you get further and further into the financial report. Within the basic financial statements, there are 2 groups. There are the government-wide financial statements and the fund financial statements, as well as the notes to the financial statements that are an integral part of both, that support and highlight and elaborate on and explain the information in the financial statements. The introductory section of the CAFR, it does have some interesting information in it, although it needs to be emphasized that it's all subjective and unaudited. It's very rare that a government will engage its auditor to even take a look at what's in the introductory section. So you should always be a little bit cautious about using that information, and just be aware that it's not audited, that it may have some spin on it, and that you want to maybe take it with a grain of salt. The typical things that you see in the introductory section are a list of the government's officials, perhaps an organizational chart. If they've received an award for financial reporting from the Government Finance Officers Association or the Association for School Business Officials International, they tend to copy it into their financial report, tell you how many years in a row they've won it. But the biggest part of the introductory section is what's called the letter of transmittal, which is a communication from the government to you to in fact transmit the financial report to you as the user, to provide information they believe is important for you to understand about the government and about what you're likely to find in the financial statements. Of course, I got ahead of myself a little bit here. The accounting standards, it should be emphasized, don't say what should be in a letter of transmittal. So the guidance the governments are getting is mostly the guidance that's provided in practice through the Government Finance Officers Association in their book called Governmental Accounting and Financial Reporting, or GAFR. It's also referred to as the Blue Book because as long as it's been printed, starting back in, I think, 1951, it's always had a blue cover. One of the very first things you're going to want to look at when you get into the financial section is the auditor's report. You want to see, did the government in fact follow the accounting standards so that you can rely upon the information that's in those financial statements and notes without worrying about whether it is in fact an accurate representation of the financial results for the year. You're looking for that phrase, present fairly in all material respects. Did want to make a point, and this particular version is a little bit out of date. They've just, about a year or so ago, made some pretty significant changes to the content of the auditor's opinion. But if you look at it, I think it's illustration E1 in the in an analyst's guide to government financial statements. That version reflects the up-to-date language in the audit opinion. But my point of showing this paragraph about RSI is to emphasize the point that RSI is not audited, but at least at this point now they mention it. They didn't used to mention it at all, even though it's required. So a government could, for instance, leave out MD&A, and you'd read the audit opinion and not even know that they had left out something they're required to do as a part of GAAP. So at least if a government doesn't do something it's required to do, as in terms of RSI, the audit opinion at least mentions it, even though it doesn't affect whether the government gets a clean audit opinion or not. Let's take a quick look at MD&A. This precedes the financial statements. So it's following the usually right after the audit opinion and before the government-wide statement of net position. It's a narrative. When it's done well, it really helps you to understand what happened in the government in that year, because certainly the person who's writing this, the finance officer, knows a lot better than anyone else what happened with the finances of the government over the past year. It is supposed to be objective. The auditors, even though they don't audit this, are, or at least looking at it to make sure it's consistent with the information in the financial statements and notes. If a government makes an outlandish claim, I think most auditors will at least ask them to back it up, even though they're not really auditing this information. The MD&A starts with what ought to be a brief description of the basic financial statements, but in fact tends to run on for several pages. And if you look at that illustrated MD&A in the book, I think it bleeds on to the top of the 5th page. But the heart of it is the presentation of condensed information from the financial statements and notes, and some analysis and discussion here. MD&A, management's discussion and analysis. Trying to help you to understand the major things that happened and why they happened during the year. You will always see at least 2 years worth of information, the year covered by the financial statements and the prior year. If they use comparative financial statements, meaning they present 2 years worth of financial statements, then you'll actually see 3 years of information in MD&A. This is condensed information from the statement of activities, and it's presented in a more traditional income statement format here than it is in the statement of activities, which has a somewhat unusual arrangement because of its purpose. But you can see this will start with revenues and give you a total for revenues, which there actually isn't a revenue total in the statement of activities. Total expenses, and then change in net assets, or change in net position for the period. That phrase is out of date. I really need to update this slide. Some governments will use charts. If they're doing the better ones, will use graphs and charts that are helpful to you, that really give you a quick sense of what you're seeing. There should be an analysis of information from the fund financial statements and an analysis of major things that happened in the budget during the year. And there's a real emphasis on significant changes in the budget. Not every single change really ought to be covered, but really just the major things that happened during the year. some information about their capital asset and long-term debt activity during the course of the year. If they use the modified approach to report any of their infrastructure, then they will provide some information about the condition of the infrastructure in MD&A as well. And then they will end up with this section that is called currently known facts, decisions, or conditions in the standards. So if they're aware of something like a subsequent event that they really should bring to your attention because it might make a significant difference, the things just aren't the same as they were at the end of the fiscal year covered by the financial statements, this is where they will cover it. In most cases, governments don't have anything of great significance like that to share, and so mostly what you see in this section is information about the succeeding year's budget, some economic and demographic information, and maybe some information about legislation or something that's going to be relevant. But it's not usually as earth-shattering as this particular example, which I've been using now for like 16 years because it's just one of the best examples. It's from a school district, and subsequent to the end of the fiscal year, the Supreme Court in Ohio found the statewide education funding system to be unconstitutional. And so that kind of threw everything up in the air, a lot of uncertainty about what the state education aid situation was going to be going forward. That's a pretty significant one, and I've never seen a better example. Lastly, on MD&A, I just want to say that there is a list of items in the standards in Statement 34 about what MD&A should contain. Because it is required supplementary information, the auditor will insist that it include only the things that are specifically required, although it's really hard to say that a government couldn't include something if it made the case that it related to one of those items that is specifically identified in the standards. The first two financial statements that you see after MD&A are referred to as the government-wide statements. There's a statement of net positions and a statement of activities. Wow, I really do need to update these slides. I thought I had. I think I just missed that. Please don't think I'm using out-of-date slides. I did update these slides, but I've obviously missed a couple of net assets that should have been changed to net position. Like all of the financial statements except the governmental fund financial statements and the proprietary fund cash flow statement, the government-wide statements use accrual and an economic resources measurement focus. They make a distinction. Oh, look, I did update it. Ha! Maybe I should have reviewed the slides before I did this presentation. I'm telling you, I did review the slides, but obviously I missed that. Most of the time, you're going to see the statement of net position, as I said in part one of the lecture, in a net position format, but it can be presented in a balance sheet format. This is a net position format, and in fact, it is also a classified format because it separates current assets from non-current assets and current liabilities from non-current liabilities. You see it's in the order of the accounting equation: assets, then deferred outflows, then liabilities, then deferred inflows, and at the bottom is net position. You're going to see all the assets in here because we're talking about accrual and economic resources, so not just cash and payables, but you're going to see capital assets at their historical cost, less accumulated depreciation. I mentioned briefly before the modified approach, and I'm not going to get into tremendous detail here, but governments for infrastructure assets, they have the option, if they have an asset management system that meets certain criteria, to, instead of depreciating those assets, to each year report an expense for their preservation and maintenance costs necessary to keep that infrastructure asset at a consistent physical condition level that the government chooses beforehand. And so sometimes you will see some or all of their infrastructure reported as non-depreciated capital assets, similar to land, which is also not depreciated, and construction in progress. All other assets, all other capital assets, are depreciated. The liabilities include both short-term liabilities like payables and long-term debt, and as we will learn, long-term obligations related to pensions and other post-employment benefits, or OPEB. Mostly what we're talking about there is retiree health insurance. We have an entire unit of the course devoted just to post-employment benefit. Net position then, the bottom line after assets and deferred outflows of resources, subtract liabilities and deferred inflows of resources, is presented in three components. Net investment in capital assets, which is the net book value of the capital assets less any outstanding debt that was issued to construct or purchase those assets. Restricted net position are resources that are externally limited to being used only for a specific purpose, and then all of the remaining net position is considered unrestricted net position, which technically should be available for any purpose. And that's what a typical net position section might look like. The restrictions are required to be shown by the purpose for which the net position is restricted. So, one thing to keep in mind, and we will have this conversation, I think, from time to time about government-wide statements versus governmental fund statements. The governmental activities in the government-wide financial statements are more or less synonymous with what is reported in the governmental fund financial statements, plus you have, in most cases, the internal service funds included in governmental activities as well. Obviously you're getting a much more comprehensive view when you're looking at accrual-based financial statements than you are when you're looking at modified accrual. But modified accrual isn't attempting to give you a comprehensive picture of the government's financial health. It's intended to give you a sense of its short-term financial health and what its short-term financial needs are. So you're going to want to look at ratios from both the government-wide financial statements and from the governmental funds, because sometimes they will tell somewhat different stories, and the difference in the stories that you see can be really informative about what's going on in the government. Some of the notes related to the government-wide financial statements include the capital asset note, which shows how capital assets changed during the fiscal year covered by the financial statements. It breaks out all of the assets by type, differentiating between those that are depreciated and those that are not depreciated. It shows you what the beginning balances were. So unless there were some adjustments, that's probably what the ending balances were for the prior fiscal year. What amounts might have been added during the year. Amounts including new depreciation for the year. If assets are retired or impaired, they're removed, and then you end up with that ending balance in the right-hand column, which ought to tie to the government-wide statement and net position. I'm just showing you the governmental activity section, but for this government there would also be a section with the capital assets for the business type activities as well. One of the other things this note does is it takes the depreciation expense, which it has shown you first by the types of capital assets that are being depreciated. In this case, they've broken it out: buildings and equipment, buildings and improvements, equipment, and infrastructure that isn't being reported using the modified approach. This government uses the modified approach to report its roads, so they're not depreciated. But then you can also see how this depreciation expense is divided among the expense categories in the statement of activities, because You can't see it. It's buried within those numbers with all the other expenses related to each of those programs and functions. But this note disclosure shows you how it's allocated among those programs. Like capital assets, like a lot of other items that are shown in the aggregate on the face of the financial statements, there are note disclosures that then break them up so that you can see their major components. The same is true for receivable and payable balances. That there are often lots of different kinds of receivables and payables, and so there is a note disclosure that will show you what the different types of receivables and payables are that aggregate up to those total numbers that are reported in the financial statements. Also, if there are receivable balances that are not expected to be received during the coming year, they will be specifically identified within this note disclosure, which is really useful if you're looking at short-term available resources. You don't want to think about a receivable that's not going to be collected for at least a year. And this is what that might typically look like, where you see the government's different activities and funds on this side, and then the different types of receivables across the top, and the payables schedule is the payables note's going to look very much like that. The long-term liabilities reported on the face of the financial statements, you may see some detail there, but often you might just see a total long-term liabilities amount broken out between the portion due within a year and the portion due beyond a year. So the long-term liabilities note really gives you a lot of valuable detail about what types of liabilities they are, different types of bonds and other forms of borrowing versus compensated absences, claims and judgments, and other types of long-term liabilities. Like the capital assets note, you see what the beginning balance was, which in a lot of cases is what the ending balance was for the previous year, new liabilities incurred during the year, satisfaction or repayment of liabilities to arrive at the ending balance, which should tie to the statement of net position, and the portion of that ending balance that is due within 1 year, which should tie to the current portion of the long-term liabilities that is reported in the statement of net position. Again, I'm showing just the governmental activity section here, but if the business type activities have long-term liabilities, which they typically do, they'd be shown in the note disclosure as well. Governments are required for their outstanding debt to show what the debt service requirements are going forward. They're shown separately in principal and interest components for each of the next 5 fiscal years individually, and then in 5-year increments thereafter until the very final maturity of the outstanding debt. If the government has variable rate debt, it bases those debt service payments in the future on whatever the variable rate was as of the date of the financial statements. Moving on to the second government-wide statement, the statement of activities. This is a statement that doesn't look like most financial statements that you're accustomed to seeing, but it's not really that hard to figure out once somebody has shown you the way around, and it has some really valuable information that it presents that justifies the way that it's put together. It moves across the top from left to right and then continues downward on the right-hand side. So let's look at each of these sections individually. The first section on the upper left-hand corner is where the expenses are reported. This is accrual-based information, so it's really the full cost of services shown by function or program, separately for the governmental activities and business type activities. And if they've got discretely presented component units, you would see those down here. The next section over then are the program revenues related to those functions and programs. Program revenues are either charges for services or grants and contributions, and governments are required to show those separately for operating and capital, and then show a total for the program revenues. So those are all revenues that are generated by the activities themselves, either because they're charging customers or for something like police, maybe revenue from fines and speeding tickets and so on, or grants that are restricted to being used for those programs. And that brings you to the upper right-hand corner of the statement of activities, which is the net expense and revenue section. And that's where you're seeing the difference between the cost, the expenses, and the resources that are generated by those activities themselves, so that you end up seeing a number that tells you the degree to which these activities are self-financing, or vice versa, the degree to which they are dependent upon tax revenue and other general revenues to be financed. So you expect to see for governmental activities that those are going to be negative numbers, and often very large negative numbers, because these are the types of services that are tax supported: education, police, fire, culture, parks, sanitation, generally are tax supported. So you expect to see a large negative number there because they don't tend to be self-supporting. And I think in some cases, like police, I don't think anybody wants the police to be self-supporting. What would they have to do if they had to raise enough revenue to cover their own costs? I would not want to be a driver in that town. You tend to expect to see business type activities have a positive number or a net revenue, meaning that they have raised sufficient resources to cover their costs, although sometimes you will see some that do not. And in fact, there are a couple here that are not self-supporting. Then the lower part of the of this, once you've established what the net cost is, the lower part of the financial statement explains how that net cost was paid for by showing you, first and foremost, what the general revenues of the government are, most of which are going to be taxes. But you'll also see unrestricted intergovernmental aid here and investment earnings as well. If a government has special or extraordinary items, those are shown separately from the general revenues. Transfers are shown separately. Capital contributions are shown separately as well. I'm not going to get into the detail about special and extraordinary items. They're covered in the book, and you can read them off of the slides as well. So those are the two government-wide financial statements. The other financial statements are referred to as a group as the fund financial statements. So all of these statements are presenting information disaggregated among the funds. There are three categories of funds for which financial statements are presented: governmental, proprietary, and fiduciary. And we'll walk through each of the three. The governmental fund financial statements present information about 5 types of governmental funds. The general fund is the central operating fund of the government, and is where everything that's not reported or required to be reported in a separate fund is reported. Special revenue funds tend to be operating funds as well. They account for specific revenue sources that are either restricted or committed to being used for specific purposes other than debt service, that is the repayment of outstanding debt, or capital projects, because there are separate fund types for those. Debt service funds account for the repayment of debt, and capital project funds account for the cost of acquiring and building capital assets. And then lastly, there are permanent funds, which account for resources that a government is required to keep in perpetuity. For instance, this is where you might see a cemetery fund, where people will pay money into that fund, essentially prepaying their cemetery plot, and the government is required to keep the corpus of that no pun intended. That's perilously close to corpse, isn't it? The principle of the money in there intact. They invest it, and they use the proceeds of the investments to fund the service, in this case the care of the cemetery. There are 2 governmental fund financial statements: the balance sheet and the statement of revenues, expenditures, and changes in fund balance. You see, as you do everywhere, there is a statement of financial position and a statement of resource flows. Governmental fund financial statements focus on major funds, meaning they're showing the most significant funds individually in their own columns. The general fund is always a major fund. And then other funds that meet the following quantitative criteria are required to be reported as major funds. Governments can then also report any other fund as major if they think it would be important to do so. The remaining funds that aren't major are reported, aggregated in a single column and labeled non-major funds. One of the things that is difficult about major fund reporting, and it really, at the time that Statement 34 came out in 1999, it was a really big improvement, because previously funds were aggregated by type. So you saw all the special revenue funds totaled in a single column, all the debt service funds in a single column, all the capital project funds in a single column. And that really wasn't tremendously helpful, because those funds that were aggregated in there all were doing different things, and people really wanted to see what was going on underneath those. So the idea of major fund reporting was to show the most significant, the largest of those funds all by themselves on the face of the financial statements. But one of the downsides is that there are some funds that you're interested in that are aggregated under non-major, and if a government doesn't prepare a CAFR and therefore present combining financial statements that break out the non-major funds individually, then you can't see those funds. Of course, you couldn't see them before either. But at least from the perspective of people, for instance, who were interested in debt service funds, they could at least see the total of all debt service funds. But in truth, that number was never very useful to them then either. But it isn't a perfect presentation. It does have some problems. So this is what a balance sheet might look like. Those are the major funds for this particular government. The sewage fund is probably a special revenue fund. You can see there's a capital projects fund as well, and then all the rest of the funds are aggregated under the other governmental funds. This is the fund balance, the balance sheet presentation, where you have assets plus deferred outflows. This particular government doesn't have any deferred outflows in the governmental funds, but if it did, they'd be presented here, and then there'd be a total assets plus deferred outflows. And then they have the lower section here, the assets plus the deferred outflows equals the liability, the deferred inflows of resources, and fund balance. Fund balance then is the bottom line. It's the corollary to net position, but under modified accrual in the governmental funds, it's called fund balance. It's reported in 5 components. The first is non-spendable fund balance, which is essentially things that are not in a spendable form, like inventory, or things that a government is not allowed to spend, like the corpus of a permanent fund. Everything else then is technically spendable fund balance, although I really don't like to use that term. Restricted fund balance is the first of the categories there, and first of the classifications of fund balance, and it's the same meaning as restricted net position. It's essentially a limitation that is imposed externally on the government's ability to use those resources. Committed fund balance is legally limited to being used for a particular purpose, but that legal limitation is imposed by the government itself using its highest level of decision-making authority, and as long as that imposition remains, it has to use those resources for those purposes unless it uses that same highest level of decision-making authority to change or remove the constraint. Assigned fund balance are amounts that a government intends to use for a specific purpose, but the government could go ahead and use them for some other purpose, and it wouldn't have to do anything, to allow it to do so the way it does for committed, or as it would for restricted. It would need to get the permission of the resource provider. And then lastly, unassigned fund balance is everything that's left over. And so basically, the amounts that can be used for any purpose, they're completely unspoken for. The only place you should see positive fund balance is in the general fund. You typically don't see any numbers at all on the assigned, on the unassigned fund balance line, unless they're negative numbers, and that means that the government spent more in that fund for purposes than it had resources available, and therefore those negative numbers are placed on the same line as unassigned fund balance, because if the resources weren't available in that fund, where did they come from? They couldn't have come from one of the other funds, because those funds, those resources are, can only be used for those purposes. So they must have come out of the unassigned resources that were available in the general fund. So this is what a fund balance section might look like. Governments are required to present some detail below non-spendable, restricted, committed, and assigned. This government doesn't happen to have any committed fund balance. That's not uncommon. Some governments might in fact not have a decision-making authority that rises to the level of a commitment. Something where it's firm enough that unless they went back and undid or changed the commitment, that they would be legally prevented from spending that money on any other purpose. Governments can present as little as just the classification totals, so total non-spendable, total restricted, total committed, total assigned, total unassigned, and then show the detail below that in the notes to the financial statements instead. Both of the governmental fund financial statements have a reconciliation that explains how the information in this financial statement is different from the information for governmental activities in the government-wide financial statements. And sometimes that's on the face of the statement itself, and sometimes it is in a schedule on the next page following the statement. So for the balance sheet, the reconciliation is explaining why total governmental fund balances is different from total net position for the governmental activities in the government-wide statement and net position. The other governmental fund financial statement, the resource flow statement, is the statement of revenues, expenditures, and changes in fund balances. You see the revenues and expenditures. Here are the other financing sources and uses that we talked about in the first part of the lecture. All of that leading to a net change in fund balance. It's worth pointing out that you will always see debt service shown separately, sometimes in principal and interest components. You'll always see capital outlay shown separately as well. And again, the organization is the same. It's the major funds, the non-major funds aggregated in a single column, and then total governmental funds on the right-hand side. And here's the reconciliation that goes with this statement, which shows you the difference between the net change in governmental fund balances in this statement from the change in net position for the governmental activities in the statement of activities. Sometimes, if the reconciliation, is highly aggregated, particularly if it's on the face of the financial statement rather than on a succeeding page, a government will provide a note disclosure that lays out the reconciliation in much more detail. Some of the notes related to the governmental fund financial statements include the note disclosures related to interfund balances and interfund transfers. Typically in the balance sheet you will see a single line for due to other funds or due from other funds, and in the statement of revenues, expenditures, and changes in fund balances, you see a single line for transfers to other funds or transfers from other funds. So these note disclosures are breaking that total out to show you how, in more detail, how the information, how the money flowed from one fund to the next. A typical one might look like this. And so this is the amounts owed from one fund to another. And you'd see a similar one for interfund transfers. Here are the amounts that during the year were transferred from one fund to another. So those are the governmental funds. The proprietary fund financial statements are reporting two types of funds: enterprise funds, which are essentially synonymous in most cases with the business type activities that are reported in the government-wide financial statements. They are activities that charge customers for the goods or services that they provide. They can be used for any activity that does that, but they have to be used if any of these criteria are met. The other type of proprietary fund is the internal service fund. That fund type is aggregated in most cases into the governmental activities in the government-wide financial statements, but it operates in the same manner as the proprietary funds. They're charging a fee for service, but rather than doing it to external customers, internal service funds are providing goods and services to the rest of the government, like a central automobile pool or central gas fuel function, central supply function. They're providing services, to departments and offices and programs of the government rather than providing them externally. But they set the charges, at a level meant to recover the cost of providing the goods and services. And so for that reason, they're reported in the proprietary funds with the enterprise funds. There are three financial statements for the proprietary funds, the first of which is a statement of net position. This is required to be presented in the classified format, showing current and non-current separately. Whereas it's optional for the government-wide statement of net position. Enterprise funds are shown using the same major fund reporting as governmental funds, and if they have non-major funds, they're then aggregated in a column. This particular government doesn't have any non-major enterprise funds. It shows all of its enterprise funds individually. The internal service funds are aggregated in a single column on the right-hand side. The second financial statement is the statement of revenues, expenses, and changes in fund net position. So your accrual-based resource flows statement. It is required to be shown in an operating format, meaning that they distinguish between operating and non-operating revenues and expenses. And then the third proprietary fund financial statement is the statement of cash flows. Governments are required to use the direct method for operating cash flows, and they show cash flows in four categories: operating, non-capital financing, capital and related financing, and investing, which is different from what is required by FASB standards, but it's very, I think, simple to show you how they differ. So GASB standards on the left-hand side, FASB standards on the right-hand side. There are certain grants and subsidies that are reported in non-capital financing for governments. For instance, general education aid that is provided by the state, to state universities. That it's basic appropriation support. That's reported in non-capital financing and not in operating by public colleges, universities. Private and not-for-profit colleges and universities report that among the operating. In the governmental cash flow statement, a distinction between borrowing for capital purposes and borrowing for non-capital purposes. They're shown in different areas, whereas all borrowing is shown under financing cash flows under FASB standards. Capital investment and borrowing related to capital investment is shown as capital and related financing, but the capital investment part is included in the investing category under FASB standards, and then what is left in investing for governments in cash flows, this is really just talking about investments. like bonds and stocks and notes and stuff like that. Uh, and that's also included in here under the private sector standards. But they also include capital investment as a part of investing, which makes sense if you're talking about a corporation, but doesn't really make sense for a not-for-profit or a public entity. And this is what a typical cash flow statement might look like. Again, major enterprise funds, internal service funds in the aggregate, and then each of the 4 types of cash flow shown separately. At the bottom of the statement of cash flows, there is a reconciliation that shows you how the net cash provided by or used by operating activities differs from operating income or loss in the accrual-based statement of revenues, expenses, and changes in fund net position. The last group of fund financial statements are the fiduciary fund financial statements. The activities reported in these financial statements do not appear in the government-wide financial statements because these are activities in which the government is taking care of money that belongs to other entities, other governments, individuals. It doesn't belong to the government. The government can't use these resources, and therefore you don't want to report them in the government-wide financial statements because it might give the impression that those resources are available to the government. There are 4 types of fiduciary funds. The most common probably are pension and other employee benefit trust funds. Investment trust funds are used for if a government is running an investment pool. The portion of the investment pool that belongs to other governments is going to be reported in the fiduciary funds. The government's own portion is reported as investments in its own financial statements. Private purpose trust funds, so these are trust funds for purposes other than investment pools and pension and OPEB funds. And then lastly, agency funds, which are used to temporarily hold on to resources before passing them on to other entities. The 2 most common examples of these, I think, are tax agency funds, where, for instance, a state might collect sales taxes for all governments in the state and then send the portion that belongs to local governments or counties to them subsequently, but they're all collected at once by the state. The other one is a payroll clearing fund, where the government might put its withholding taxes, its FICA, its Medicare withholding, into this fund temporarily, and then periodically make payments out of that fund to the state government or the federal government. There are 2 financial statements for the fiduciary funds. The first is the statement of fiduciary net position. You'll note that the fiduciary fund financial statements aggregate the fiduciary funds by type. So if they have multiple agency funds, they're all under one column. If they have multiple private purpose trusts, they're all in one column. You'll also notice that there's no net position for agency funds, and that's because these resources are held for a very short period of time. So all of the assets in the fund are matched by an equal liability representing the requirement to subsequently disperse those resources to whoever they belong to. Whereas in the other types of funds, in those trust funds, the government is holding on to those resources for an extended period of time. The second statement is the statement of changes in fiduciary net position. So there's your resource flow statement, and you will note there's no agency funds here because they have no net position, so there's no change in net position to be shown. What you are going to see here, rather than revenues and expenses, is additions to the trust, or additions to the fund, and deductions from the fund. So those are the financial statements. The one other part of RSI that I wanted to take a moment to talk about are budgetary comparisons. Governments actually have the ability to report these as basic financial statements if they want to, but they're encouraged to present them as required supplementary information. They have to present a budgetary comparison for the general fund and for any major special revenue funds for which a budget is formally adopted. So this is what a typical one might look like. The inflows and outflows, or revenues and expenditures, however they're titled, either can be shown using the categories from the government's budget or the categories from the governmental funds statement of revenues, expenditures, and changes in fund balances. There are three columns that are always in the financial in this comparison: the original budget, the final budget, which includes all changes, all adjustments made to the budget throughout the course of the year, and even in some circumstances after the end of the year, and then the actual amount presented on a budgetary basis, so the absolute final amount. You will sometimes see variance columns like this one on the right-hand side that show the difference between the original and final budget, or the final and actual amounts, or sometimes the original to the actual amounts. That's the one I happen to think is the most valuable if you can get it, but we will talk about how to calculate those variances. It's really very simple to do, and it's a very valuable exercise to engage in. You will also see a reconciliation either on the face or next to it, or in greater detail in the notes, explaining how these budgetary basis amounts, the actual amounts on the budgetary basis, so whatever the accounting basis is that's used in the budget, which is something usually very close to cash with some encumbrances on top of it, how that differs from the amounts that are reported in the under modified accrual in the governmental fund statement of revenues, expenditures, and changes in fund balances. And I'm not going to get into any real detail here on these other pieces of information, but there, in addition to MD&A, and the budgetary comparison, if a government has a risk pool, there's some information it's going to present in RSI. We will talk in a lot more detail about the RSI related to pensions and OPEB later in the semester. And then if they're presenting a CAFR, they're going to present a lot of supporting statements and schedules, and they'll have the entire statistical section as well that goes along with the information in the financial statements notes and RSI. And I'm not going to go into any great detail on this. There's a lot more information that in the book, which you're going to end up being required to read, and we'll talk about them in more detail as we go along through the semester. But in order to keep this manageable, because you've already been listening to me between these two parts for 2 hours or so, I don't want to take up any more of your time, even though the first unit is a little bit longer. Also take a look, this last bullet, there is a presentation, a set of slides in the document sharing area of the course website that talk in more detail about the statistical section, and I encourage you to take a look at that, although you will find just as much information distributed through an analyst guide to government financial statements by topic, but the slides are dealing with the statistical section all together in one place. So that's the end of the first lecture, and I look forward to conversing with you on the course website.